Well, Netflix may be under pressure to eke out profits from its streaming service, but one investor says the streaming giant's focus on pure play video streaming makes it a strong buy against its competitors. Here with his take, Ken Leon, CFRA Research Director of Equity Research. Good to see you, Ken. So we heard a little bit from people on the street there. And of course, when we look at what Wall Street was honing in on, the subscriber numbers, some of that week forward guidance in the quarterly reports, you still have a strong buy, though, and a 12-month price target of $390. What's your base case there?
So obviously, we had kind of a stall with the first quarter results where a lot of the questions from the previous video clip is what does Netflix look like as it goes more significantly to paid sharing or friends and family, kind of getting those accounts to revenue. We're going to see that in the second quarter. Canada in the first quarter at least gives an indication that you do see some churn or cancellations. That's why they only had 1.75 million net adds and subscribers, but they have 232 million, far more than anyone else. And the other issue really relates to the ad pay plan. There hasn't been any cannibalization from the higher ad-free plan. And then advertising revenue really is not going to be material until next year. Add it all up for Netflix, it's not self-inflicted, but this is really an adjustment for longer term growth. They increased their free cash flow target from 3 to 3.5 billion at the end of this year. And we still don't see any immediate competitors that are really going to take significant share from Netflix. Netflix management believes in the next 2 years they will gain share in all of its markets. About 45% is North America, rest of the world is the rest of their business.
And so then, as you compare some of the streaming services, then you seem to think that Netflix is going to have that edge there. What are some of the risks, though, that also come with such a crowded space?
Well, the risk is really viewing time, and that is not only for subscriber revenue, but it also spills over to what advertisers, where they want to put their money. When you look at the largest percentage of viewing time, the big four is Amazon Prime Video, YouTube, owned by Google Alphabet, and then also Netflix. And the fourth coming up is TikTok. The rest of the competitors are really going to grapple for, if they're going to be a strong streaming competitor, how do they do that? And it gets complicated and makes them a step slower than Netflix, which is a pure play on streaming.
And so obviously their pure play on streaming is what got them here. But what about the next leg of growth? We mentioned some of the password sharing and the ad tiering as well. A lot of people are sort of eager for this, but we're seeing this slow rollout as Netflix wants to sort of learn as they go and see the reaction from consumers. What is your take on how they're rolling this out?
Well, we're investors, you're never going to get back to the hyper revenue growth. They really want to get back to double-digit growth, at least 8 to 10% from, again, a flat guidance for the second quarter on revenue versus the first quarter. The second key metric is profitability and operating margins. As they went through this transformation, they have dipped down to 18, 19%. They want to get back up to 21%. So that speaks to growth and profitability, and those are the key factors that are really going to drive operating performance, but also get the stock higher. I have total confidence that their $17 billion content spend on programming and film is the most efficient and highest return. And they got a global platform that enables them to have local programming by country and then share it in other parts of the world. So we do have the risk of a film writer's strike coming up. Hopefully that doesn't happen, which would be a negative for the industry and for Netflix. But overall, we got a management that's been in place, even with the new co-CEOs, for the last 15 plus years. And, you just have a great opportunity, an enhanced buying opportunity with the stock at 325 or so. We got back on board with a strong buy at 305. Our price target is 390.
And so then I want to talk about some of this corporate strategy here. When you have these co-CEOs, what does that sort of model do for Netflix that it didn't have under Armstrong, under Reed?
So I've been tracking industries for decades, and usually it doesn't work, but I think in some cases it does. When you look at Netflix culture, from Reed Hastings to the two co-CEOs and the CFO, they have been doing this for a long time. So they have, in their own sense, their own community, and they're able to balance their egos. Whereas, of course, we saw the problems with Disney with appointing CEOs and a regime change in terms of organizational structure and management, that Bob Iger had to come back as CEO and kind of realign so that they can drive performance.
And something that I do want to ask you about, because gaming, another aspect that Netflix wants to get into, but that's also part of the rationale for Microsoft making a play for Netflix. You have Microsoft President Brad Smith also sitting on the Netflix board. What is the likelihood of a deal, and what would make the deal make sense?
Well, for Microsoft, they have a partnership. So the technology platform and cloud that Netflix is using has selected Microsoft. Additionally, they also see an opportunity perhaps in any of the software base, but where there could be competition is gaming. So Netflix, it's all about getting people's eyeballs and having long viewing time. So besides watching any kind of episode or film content, gaming is going to come into play. Netflix so far hasn't made acquisitions in a big way, low 100 million. But gaming is an interesting area for Netflix, so you don't have to change the channel.
Always great to get your insights. Ken Leon there, CFRA Research Director of Equity Research. Thank you so much.